Okay, so this is a recent case study we did a couple years back actually for an industrial warehouse for a client who owns a lighting business. They do like LED lightings and stuff for other businesses basically, so larger scale lighting. And they were going through, this was just right after COVID. So during COVID, they did face some sort of financial deterioration in their financials. So what happened is their debt service ratio, so their income was decreasing and their net income also decreased to a point where they don't debt service anymore. And the banks, every year, the bank does something called an annual review just to make sure if all your ratios are in line. So this is their way of stress testing your business to make sure that are you still within covenants, they call it. On the residential side, banks don't do annual reviews. Once you get a 2-year term or a 5-year term, they don't check your income at all until you renew. And even when you renew with the same bank, they don't even check your income, I don't believe. Right? So in
Typically.
this situation here with commercial loans, every year the bank will check your debt service ratio to see if things are in line and all the other covenants. So unfortunately, in her situation, the business was actually on a downward trend due to COVID and a few external factors. And so she breached her covenant. And basically they moved her file to something called special credit, which means she has a few months to basically pay the loan out. And during that time, she couldn't find a new lender. So then the bank demanded their loan back, basically.
Yeah, and then originally she went to a broker, another broker, who was a residential broker, and they didn't really know where to go. And they suggested a private lender around like 9.5% at a time and a 2% fee. So, not taking that for an answer, they started, we got this referral from a one of our accountants, COIs, and they were like, "Hey, can you help my client?" And so we were looking at her file, and it was like, "Hey, you know what? This is actually a perfect deal for some of the local credit unions that we could probably go to." So we looked at her business, and we looked at her entire net worth, and we found out there's another business that she owns that actually cash flows really well. So we're able to reposition the story around her. We're in a warehouse, and then she actually has another cash flowing business. So we're able to tie that all together and present it to our lenders. And they really like the story and they like the business. And they do have a good turnaround plan for the lighting business as well. And they're already seeing positive results. So, after about 2 months, we're working pretty hard with our lenders. We were able to refinance them out. We got them a little bit more money. That also helped save them on some of the prepayment penalties as well, because she had to pay out of pocket. And she was able to actually get around the same rate that she would have got from her original bank, and much lower rates than the private rate, so she would have been paying.
Yeah, and that's key. I think what happens is that on a typical deal like this, no matter which bank she went to, they would have said no. Part of it is that as an owner, you don't know what to show the bank. So you're just telling them the story. And if the bank looks at just your lighting business, yeah, they're right. The deal does not debt service. And sometimes packaging is important, packaging the deal is important, and also showing how you mitigate the risk. So you have to really position the deal to go, here's the challenge, but here's how we can mitigate any of these risks so that A, the loan is safe for the bank, and B, the client can still make these payments for the bank too, right? So on the day, there's no point of moving client to a bank and then she can't make her next payment. So we did a lot of questions, like I guess a lot of digging, and we asked the clients a lot of questions where we figured out she had another company, and we leveraged on that cash flow to make the deal work. Unfortunately, the situation when you breach a covenant, and say you take a 5-year term, and you're 2 years in, and say you breach a covenant and the bank demands a loan back, and you got 3 years left, there's going to be a prepayment penalty. Even though the bank's telling you to leave or pay them back, you also have to pay that penalty, unfortunately. So her penalty was massive. It was quite a large loan. So it was around like $300,000 for the prepayment penalty. And so what we did was we actually went to TD. I knew a few people there, and obviously we talked to them, talked to the credit team, and we basically just try our best to negotiate the amount that she pays. So we were able to reduce that amount down in half. So she ended up paying $150,000 in prepayment penalty, but she saved, in a sense, $150,000 from the entire amount. So I think that's a big win for this deal here, in terms of just moving her to a tier one bank, so keeping the same rates and also saving her on the prepayment penalty as well.